Good afternoon, everybody, and welcome to our Libro's webinar on business succession planning. We're very happy to have you join us today. We know a lot of business owners and in our ag community are really busy, and especially are really busy at this time of year. So appreciate those of you who are joining us live or are perhaps watching this recording at a later date. My name is Paul McQueen. I'm the Vice President of Wealth here at Libro. I've been with Libro for about 10 years now. I'm really proud to work with our financial planning, insurance, and wealth management teams. I'm joined today by Doug Carroll, who'll be on the screen momentarily. Doug is a tax and estate specialist with our partners at Aviso Wealth. Aviso Wealth is our dealer for anything that we do in terms of the investment side of the business, mutual funds and other investments like that. Doug previously ran an estate planning law practice and was an advanced case consultant with both a life insurance company and mutual fund provider. Doug holds a business degree and a master's of law specializing in tax and is qualified as a certified financial planning professional and a trust and estate practitioner. He's been doing this for over 30 years now, supporting our financial advisors with written articles, individual case consultations, and of course, webcasts like today. On behalf of my colleagues at Libro Credit Union, I certainly want to welcome you to today's call. Libro as a B Corp is really thinking beyond just, the dollars and cents, but concepts like financial wellness. Financial wellness goes beyond just sort of financial security. And for conversations like today, might be a little more nuanced, might be a little more specialized subset of our owners that this applies to, but it's certainly part and parcel of that entire conversation. With respect to today's webinar, it is somewhat general in nature, and if you do have questions, we do ask you and encourage you to participate using the Q&A option. From our experience, we know that general questions work best. If you have a really specific question about your set of circumstances or your business in particular, we'd ask you to reach out to your Libro coach directly or myself, and we'll get you the help that you need. And don't worry if you miss a concept or you miss a note here or there today, that's fine. Recording and a handout will be available after the call in a follow-up email directly to participants and also available on our libro.ca website. So without further ado, I'd like to turn it over to our special guest today, Doug Carroll.
Great. Thank you, Paul. I am going to push up my screen. Where are we here? And there we go. So I'm sharing my screen up there, and I'm going to get into the topic here. As you said, don't worry if you miss out on things that we're talking about here, in particular with the handout piece that'll follow here. It runs exactly the same track. The topics and the subtopics are in the same order as we've got up here on screen, and they go into greater detail on it. I may say something to flesh out the topics in a different way than what's in the written piece, but it's essentially the same content that you see here that I'll take you through. So I'll go through these 10 topics, these 10 slides, looking at business succession. And the handout piece, it's not just a written running text document. It's a series of questions for you to go through. I've compressed them somewhat for the purpose of speaking on the topic here on each of the slides. But otherwise, it's a whole series of questions, 7 questions in each of these categories as you're going through these, to look at yourself and the people around you, the business itself, the time that you have, your preparation, all of these things in some kind of a structured way, so that things that perhaps were not top of mind get a little bit further forward in your mind, and you can be a little bit more prepared for the succession that you have coming up. As Paul mentioned, I'm not going to get into deep technicalities of legal and tax matters here. It's more framing things up so that you can, from a financial planning standpoint, be ready to have the conversation with the professionals who support you. And I'll talk about those variety of professionals, who they may be, in just a second. So starting with yourself, as you're looking at your succession, quite often the succession conversation, whether it's happening just in your head or just generally with other people around you who are connected to the business, will be about the business itself. But you do have to think about yourself, who you are, and who you're going to be out there in the future, what kind of planning you are providing for yourself as a retiree. And when I use that term, I'm not saying that you are stopping working necessarily. In fact, you might have a business which you've had a wonderful run with, and the whole idea from the start may have been start the business, build the business, harvest the business in some way, and then move on into another venture, perhaps. So I'm really just strictly talking about retiring away from this particular business, although if it's a lifelong endeavor, then may very well be the point where you are ceasing work. So planning what you are going to do with yourself is part of this. Looking at how you spend currently, the source of your money, a significant source of your money being the business that you're operating. How are you spending currently, and how do you expect that you're going to be spending out there in the future, which will give you a little bit of a starting point to say, how is this going to affect not just the dollars and cents of what I'm doing, but the activities that you're involved in? Ideally, you've got savings already set aside to some extent to take yourself out there in the future. The business itself would have generated income that you could have, with a surplus, placed into retirement savings, RRSP type of accumulation, or maybe you had an individual pension plan that was created, or perhaps there is cash that was left inside the business, if it's a corporation or not, where you invested that money within that structure, or maybe you took it out into your personal hands and you invested it separately from that. So a variety of places, but the big bonanza, if you will, the cash event, is likely going to be the sale of the business itself, in addition to those other things. So where have you put that other money? How is that providing for you? What kind of lifestyle do you intend for yourself to have out there in the future? Sometimes the price of the business that you would like to sell and getting yourself to that point of selling the business is dictated by the lifestyle that you already intend for yourself out there in the future. In other cases, it might be a matter of what you can get for the business then dictates to a certain extent what kind of lifestyle you're going to have in your later years. But anyway, around it, looking at yourself now and what you are going to be out there in the future, as well as looking at what's going to happen in this transactional way of the succession of the business, and who might be the successors and who might be the those who are continuing to be involved in the business, and that might even include you to a certain extent as you get forward to the point where you're going to transition the business. One of the things that for a lot of people, and particularly for business owners, you might want to think about, and this again is about how you're going to spend your later years, as it says here, when who you are is defined by what you do, who are you when you no longer do what you did? And for some people, that's very much how people define themselves, intentionally or not. They call themselves what it is that they do, and that just might be a label that you put on it and doesn't have anything more to it. Or it may be that the nature of the business and your involvement in it, particularly if it's been a very long time that you've been in a routine of what you do, the people you deal with, the social structure that is either within the business activity or even extending beyond the business activity, much of that might change at the point when you no longer are the head honcho running the whole business. So that's something to think about in terms of what you are going to be doing, how you're going to be feeling in those later years. So in looking at the kinds of professionals who assist you in running a business, I'm constantly, Paul's probably heard this about 17 times because we do these variety of sessions, and I always use this term, expert meet expert, and I really do mean it, that you've got a variety of professionals in whatever you might be doing who are providing personal service to you. And what you want to do is you want to exhaust whatever expertise they have as much as possible. And in order to do that, you need to be as forthcoming as you can be about yourself in order to get as much out of them as you can. The common professionals that come up when you're talking about any kind of business that's getting established and is running, and at the point when you're going to transfer the business, would be your lawyer and your accountant, particularly your accountant or your accounting activity. That's an ongoing type of thing. Lawyer is a little more periodic. Hopefully you don't have a lawyer on speed dial. That probably means that the business has run into the odd hiccup along the way. But these are the professionals that you commonly think of in terms of the junctures when a business comes into being, and particularly when we're talking now about transferring the business onto someone out there, whether it's someone close to you or it's someone who is a third party or a more arm's length type of person that there's going to be acquiring from you. Now we've got other professionals, consulting professionals in the field that you are operating in. So whatever the business activity you do, the widget making, there are consultants who would be involved with assisting you, hiring them to build the business from the substantive standpoint. The lawyer and the accountant might have their opinions, might have some input on things, but their responsibility is the legal and the accounting tax aspects of things. A professional valuator is not somebody you're generally going to come across in the day-to-day, year-to-year operation of a business. It really is when you need to have some valuation done for a particular purpose, because you are perhaps reorganizing at some point when you're not necessarily doing a succession. You need to have a valuation that can be it can support, or that you can depend upon from a tax point of view. And then when you're talking about a succession, obviously, if you are negotiating with another party, then you or the other party or both of you together might feel more comfortable with something of a relatively independent valuation, which is not just you coming from the standpoint of being totally on the inside and perhaps not having a view of what an outsider might look at the business, and vice versa. Somebody from the outside might be looking at it and saying, hey, it's worth this much or that much, but they don't know what's going on the inside just yet. And so a valuator can be of assistance then. And then financing the activity, whether we're talking about someone who is buying, who is not directly connected to you, again, somebody who is completely at arm's length, that you might look at it and say, well, that's not really your concern as long as they come up with the money. On the other hand, if there is some continuing connection that you have with the business, and if the financing becomes challenging and costly, then that could affect the discussion about how much might be the amount that the business might be sold for, or the terms of that, the time that it might take to have the buyout happen. That's with somebody who might be arm's length. And then we're talking about succession, intra-family particularly, but closely connected people to you, then it might be something where you'd be much more inclined to perhaps do take-back financing, where the money that you would want to get for the sale of your business is not readily available to someone who you really do want to be your successor, one or more people who you're looking to be your successor, and perhaps to facilitate that, you're going to have to think about being some part of the financing of that arrangement. And then once the whole thing comes together, and it's not to say that there is a line in the sand and you don't engage with the professionals who deal with investment matters and insurance matters, but once things come together or are coming together, then you want to make sure that you think about what's going to happen with this splash of cash that's going to arise, and who's going to assist you with it. And that would be certainly an investment professional to assist you in that respect, and as well the closing of the transaction. Part of the discussion usually involves some type of protective measures, like having insurance in place, particularly if you're thinking long-term buy-sell agreement between partners. Partners, I mean, in a generic sense, you might be in a legal partnership, but partners who are shareholders of a corporation, it might be even multi-corporations if you each have your holding companies. having insurance in place to support you, and I'm specifically talking about life insurance and disability insurance to support you should something happen in the interim until you get to the point when the buyout can happen. But even subsequent to, it might be a good reason, depending on the structure of the arrangement, to have insurance in place, particularly if there's going to be, if there's a personal, very significant personal element to the ongoing development of the business for the ongoing payments, if there are, over the course of a couple of years or a number of years, then should the successor die, unfortunately, the seller may not, in fact, realize on what was agreed upon because the business may not be there or might not be serviced in the way that you would expect would be the perfect way that things might operate. So a variety of professionals that might be involved in various aspects of the succession of the business. So then from there, we want to look at the business and specifically you yourself in the business, and as much as possible taking a dispassionate view of yourself, and the fact that you have undertaken a business, that you've built the business to the point where somebody might want to buy that business, you've been on the inside of that. And so as much as possible, you want to be on the outside of yourself to look at you and say, look at yourself and say, okay, well, what is it that I bring to the business that I develop? Not so you can just pat yourself on the back, but so that you can then step outside and say, who might buy this business and what do they need in order to carry on what it is that I've created here, I or we have created, if it's a team of people who've done that. So the skills that you have, the necessary licensing that you have, the interpersonal characteristics, and just straight up the knowledge that you have of things are things that need to be passed on. How are you going to go about doing that? How have you documented? I'll come back to that in a little bit, but how have you documented things? And if you haven't yet documented those things, then what do you need to do, and how much time do you need to do in order to document those things? The third point here is to think carefully about the nature of what it is that you have to sell or may have the ability to sell. And I look at it as a spectrum from individual to occupation to business. And what I mean by that is that ideally, you're going to have a business that is completely independent of you. You simply are the owner of something that someone else can turn the crank on and can generate the business activity out of, and then you'll negotiate on how much you're going to have as the sales price. The second or middle type of activity, as I'm referring to it here, is an occupation of some sort, where it requires someone to continue to be to have the special skills involved to be inside the business activity to make it work. So it can't just be selling and a new owner who just stands back and lets it do or causes it to do what it is. Someone who is inside that business and is applying their skill, emulating you to a certain extent of what you've done in order to create it and build it in the first place, in order to realize upon, to capitalize on the value of the business as it stands right now and grow it up further into the future. And then we have the type of business activity, which is the individual. And this might be something where you have a personality that's larger than life. You have some really special skills that nobody else has. In that case, do you really have something to sell? Because if you're not in that business, if it really is your character which has driven it in the past and you are no longer going to be there, maybe you don't have something that is saleable, or maybe it's something which you need to extract yourself from and figure out how you convert from something which is you at that extreme end of the spectrum over to something that is closer to an independent business. Then the last thing here is about these four characteristics: technician, entrepreneur, administrator, and manager. You yourself have one, two, three, or four of these occupational categories or characteristics of how you've got the business going and how you've run the business. Technician, in the way that I'm talking about this, is somebody who has, or that aspect of your character, which is the technical skills involved. So in order to run a carpentry business, you have to have woodworking skills. As an entrepreneur, you've taken the initiative. I don't think of entrepreneurship as being risk taking. I think that's a common definition that gets thrown out for conversation. I don't really look at it as risk taking. I look at it as someone who understands the nature of the market that they are facing, the opportunity that they have in front of them, and has assessed the risk in order to then take advantage of some gap in the market because they have technical skills that can be used for coming into that market. So that's the personal initiative and the money initiative that got things going. The last two, administrator and manager, they might seem like they're synonyms of one another, but then it would make a mess out of my acronym for one thing. But I look at this as being an administrator, being someone who looks at the technical and the entrepreneurial aspects of the running of the business and says, I'm going to capture that. I'm going to get it down into sufficient documentation so that someone as a manager, number 4 here, someone as a manager can run the whole thing. So all of those special personal skills of the technician and the entrepreneur, if those are the only things going on, you're probably way over in that individual as opposed to business end of the spectrum. As you get to the point where you've got administrator figuring out what it is that has to be done and putting people into roles and detailing things, then a manager can step in and work on the business. And so you might have 1, 2, 3, or 4 of these characteristics. You might, as you're looking at the continuing growth of your business, you might have to look at it and say, who do I hire as my administrator? Who do I have in here who can be that administrator who will then house these things or capture these things in a way that they can be managed so that I move further along that spectrum towards being a business? Because as independent as the business can be, that's likely the greater the amount that you can ask for in terms of the value of your business, and it's more simply that you can extract yourself out of it if it's distinguished from you personally. The likely starting point for many people is to look at family as the successors, one or more of family people. And one of the first questions about what they're doing right now as family members, whether it's spouse or it's children, maybe it's even broader than that, should they be in the business as they are now, or should they own the business? And the should is in your hands. It's not a moral determination. It's something which should be, again, a dispassionate look at the business. So you took the time to look at yourself in the first place. Now you are looking at those really important people around you, those people that you care about, and those whom you want to take care of, again, spouse and children. What kind of, especially children, usually as you're getting out of the business, what kind of abilities do they have right now that align with the business, that are necessary and that they're able to contribute with, and where do the gaps lie with their capabilities? When you're thinking about who they are within the business, again, you have to stand back to a certain extent because you are emotionally connected, and think not only about what your expectations of what they're going to be is, but what their expectations of their continuing involvement might be. When we're talking about a business, and it's a special kind of asset when you're thinking about estate planning, and when I talk about estate planning, I distinguish between, because my oldest activity was as a estate planning lawyer early on. I would distinguish between being fair or being equal and being equitable. So when you are looking at what's the appropriate thing to do to transfer on the business, it's not about being equal about things and saying, well, I've got 3 kids, and so I'm now going to have 3 CEOs in the business. You know that's not going to work. And it may even be a matter of saying, as much as I love my kids, they're not available or interested or capable of carrying on the business in a way that it needs to be carried on that will be as fulfilling as possible. And it's not necessarily all about the dollars and cents, but if you put someone in a role, you transfer on a business to someone who is not really capable of doing that, you might be giving them more stress than you think, because they then are in the position of having to operate a business that they're not necessarily so capable of doing. You also may not, despite your best intentions, you may not have passed on, coming back to the dollars and cents, the optimal value of the business. You might have been better to say, who out there, the people around you who work in the business, key people perhaps, or competitors, suppliers, customers, or some kind of further afield potential suitors who might buy it for a value that would be greater than if you pushed it onto children who are not ready and able to take that on. And the tougher part of that, so that's one part of the decision between the kids or someone else. But then when you're looking among your children, it becomes that much more challenging to say, okay, one of my children or one or two of them are able to do this, but not one or two of the others. And in that case, how do you go about structuring that? And you'll lean on the lawyers and the accountants to assist you in how to go about doing that in a technical sense. But how do you go about sharing the business ownership, perhaps, with some of your family members, and the business ownership and involvement with others? And maybe some of them are completely outside of it altogether. So you could have some kind of a proxy inheritance to those who are completely uninvolved with the business, or it could be that some will be actively involved in the business and have a greater share, while others will be shareholders but not active in the business. And depending on the nature of the relationships, then you have to be careful how you structure that, both legally and couching expectations coming into it, setting it up so that you're setting them up for success, rather than something that might be a disaster relationship wise, but also financially may not be the best way to go about it. Paul, I'm just going to hang on here for a second before I move on to the next topic. No reason in particular, but just wanted to hang on to see if there were any questions that have come up that you want to shoot at me now, or if I should just continue on with the topics as I have them.
Yeah, one question that sort of came up, and it's related to involving certain experts. There was a question about, when I'm getting ready to sell, who should I talk to first, the lawyer or the accountant? And I wanted to build on this one a little bit, just in some of our experience. And I mean this with all due respect to the professionals that our owners work with. But you wouldn't necessarily use the same lawyer for a divorce proceeding, for example, that you would for a corporate law case. And so not only who should I talk to first, but what kind of questions should I be asking that professional to make sure that they're actually ready and able to help me with these complex questions? Maybe my accountant has specialized in my tax reporting for a number of years, and that's a fantastic value add for my business. But how do I know they're actually ready for complex conversations like these?
And I think that's actually the accountant question. Generally, it's a real generalization, but in my experience, it tends to be that the accountants they're in the position to know more of the minutia of what's going on with the business. And so therefore they're in a better position to initiate if asked to do that, or maybe they take the initiative themselves to talk about succession of the business. You're likely in more ongoing contact with an accountant than you are with a lawyer. Again, I made the joke at the start that you don't want to have a lawyer on speed dial, because that means that you got problems more often than not. But it is true. Lawyers are more of the occasional contact type of thing, unless it's somebody who's a personal friend and you do lean on them in different ways. accountants, because you need your bookkeeping being done. The accountant, the credentialed accountant, may not be doing, or likely is not doing, the bookkeeping, but accounting activities are happening on an ongoing basis, and you have your tax filings, your final statements from year to year. So you're likely going to have that regular interaction with accountant more so than lawyer. That said, quite reasonably, many accountants see themselves as fulfilling, as you say, a tax filing purpose, a compliance requirement. They don't necessarily see themselves as being asked or taking the initiative themselves to look forward to advise upon this kind of thing about succession. And at an early stage, you want to bring it up with them. When I say early stage, I mean some years in advance of where you're going to get to. You want to find out whether they are keeping an eye on things for you, and to the extent that you are prepping the business for succession, that they are going to assist you. And if they're not in that position, that's fine. You might continue with them and then get a referral to someone who you eventually move over or merge over to. But you want to find out at a reasonably early stage ahead of when you're ready to go, if the professionals, particularly the accountant, but as well lawyer, as you mentioned, are the type that will assist you on the succession of the business. I'm going to shoot it back to you.
No, and that's great. Thanks. I'll turn it back to you in a moment. The only thing I would add here is I'd be remiss not to say, I mean, the other option is we do actually have some expertise here at Libro as well. We have a couple experts, Phil Boglewski, for example, our wealth planner, who's worked with a number of our owners, and Doug on some complex cases involving millions of dollars of assets and multiple corporation structures and et cetera, et cetera. If you just want an idea on what's next, especially if you've done some of the pre-work that Doug's talking about today, that you kind of know what you want to happen, which is a really important first step, then we've got some expertise to also start that conversation. So please feel free to speak to your business advisor at Libro, and we'll connect you with the experts that make sense internally.
Okay.
Thanks, Doug.
Okay. So we'll push past the family, and the next one is how I've phrased it here: your people. So what I'm talking about here is the employees within the business. This could be employees, it could be business partners that you're on an even plane with, but assuming that you alone or you with someone else together are looking to sell the business. You do want to make sure that you have a clear picture of the people who are the value in part of the business. Very few businesses are worth much at all, or near as much, just when you look at the assets themselves compared to the business as a going concern. So some of the things to look at, again, I was talking about the documentation that might have that already is in place or that you can put in place. Having good job descriptions is helpful. It's a good exercise to go through to make sure that there are clear lines. And there might be fuzzy reality, but having clear lines of ideally what this job is intended to do will just will help you structure things in such a way that you can operate the business more generally just for your own benefit on an ongoing basis. But also, it will allow for who is going to purchase the business off of you to understand the nature of the business. When you get down to the due diligence, when someone is looking at the business and they're looking over the financials in particular, if you can also show structure that is in place, not that it's freewheeling in ways that they may not be able to continue to manage themselves, then that makes it much easier for one person, whoever the successor might be, one or more people who are going to step in to continue to run the business. In addition to the job descriptions, ideally you'll have employment contracts with your key people, with your all your staff. you'll want to have agreements of some sort. So it's clear what the nature of the employment relationship is, but particularly with your key people who are in roles that are really the nodes of how the business operates. You want to make sure that you have employment contracts with them, both to make sure that that you're clear between you and the employee, and then your successor being able to step into your shoes, what it is that this person is bound to do, but also to have non-competition for this person, each of them, that they're not going to be able to step out and take the business or important components of the business, whether that is knowledge or actual assets of the business, physical assets or intellectual property of the business, and carry that over to a competitor or take it out and start up their own business in competition with the business that you have. And that's one of the things that can happen when a business is pending being sold. Someone who's been there for a long time may have contemplated doing something of that nature. Not that it's a mean thing that they're doing or underhanded, but it might be something that, given the opportunity, the prompt of the business being sold to someone new, they might decide that they're going to move off and do their own thing in some way. Operations manuals generally about the processes. So apart from the job descriptions of the nodes of what people do, the processes that are involved, similarly to get the structure clarified for somebody who's coming in. And then a question about retention of those people. It may be that the people who have been with you for a long time or a short time, they have great allegiance to the business, or maybe they just have allegiance to you. As I said, somebody might, whether they want to go off and be in a competitive business or work elsewhere, somebody might just look at it and say, yeah, I enjoyed working for you personally. But now that that's not the case, it might present an opportunity to do something else. That could be damning to the business, dollars wise, cost wise of running the business for somebody who's coming in, if some of the really important people who have kept it going to date are no longer there at that time. So if you have, again, those employment contracts, if you have the job descriptions, and you can represent in a genuine way the nature of the relationship, that you understand it and what's going to happen when you are no longer sitting in the chair, then that's going to reinforce the value of the business for somebody who is going to acquire that business. The next thing is to look at your time, how you're spending your time and how you're required to spend your time. A due diligence exercise selling a business. One, it takes some time to clean things up if they have to be cleaned up. Again, job descriptions, operations manual, revisiting those types of things. Identifying successor. That's going to take some thinking. It's going to take some time in terms of you evaluating whether you're doing it out loud or in your head, but evaluating who might be appropriate. So talking about people who are close to you as a successor that might be able to take over with things. Um, in doing that, once you get to the point where you are you're close to an opportunity to transfer the business, again, whether that's somebody close to you or whether that's family members, or it's a key person on the management team or the management team overall, or it's somebody who is at arm's length, there is a due diligence where you need to have disclosure so that everyone knows what it is that they're getting into. That can divert attention away from the day-to-day operations. And so you want to make sure that you don't go down too many rabbit holes that are not going to get you along to where you're going. That can be a waste of time and frustrating in itself, but also it diverts your attention from the income earning or the profit maximizing aspect of running the business. You yourself may be asked if you are if you need to be introducing to suppliers, to customers, just handing off the baton to the successor, particularly somebody who is at arm's length with you, who hasn't been in the business. you yourself might be asked to continue on, and that's going to reinforce the value of the business. And one of the things to think about, just in terms of your psychological expectation about how this is going to happen, is whether you will be asked, whether you need to stay on with the business. Then you'll have an idea of what your retirement or departure timeline looks like. It's not necessarily going to be the Friday that you close the door the last time with the keys before you hand them to somebody else. You might have to show up on Monday. You might have to show up for a lot of Mondays in order to support the transition over to who it is that you're transferring to. That's both a practical consideration from their side, but also it's a financial implication for you. The better that you can support, if necessary to support the business post-closing, then the greater the value that you can ask for what it is that you're selling to the person that you are transferring to, particularly if there is a contingent aspect to the purchase price, depending on how production happens post-closing. If you're not there to do the introduction and do it as well as possible, then the production that happens that is part of that earnout quantification of what you're getting paid might be less than what you thought it was going to be. So be ready that you might be asked to be involved, and it might be a significant period of time depending on the nature of the business. Ideally, there would be some kind of a buy-sell agreement, even if you're talking about business owners currently, again, peer-to-peer business owners, whether you're direct proportions or different proportions of the business. Having a buy-sell agreement in place is very important, because you get along when you're negotiating a buy-sell agreement, so that when you're not getting along, then it can be the guideline of what's going to happen. And ideally, you'll have insurance that supports that, both life insurance and disability insurance to support that, so that if the unfortunate happens, either a disability or a death of one of the people who are owners of the business, then the insurance can step in to complete some part or significant part of the financial aspect. You still lose the person when that happens. You lose the expertise, and hopefully you've got other people. Again, all of that documentation, the training of those other people around you will support that part of things, but the insurance can be then a proxy for the financial contribution and facilitate the buyout when you have that in place. When it comes then down to how you're getting paid, again, think about the valuation of the business with and without you. So you standing back and saying it's worth X dollars is fine if you are in the business, and again, you're the one who's turning the crank because you know how to turn that crank. When you are not involved in the business, then somebody else is going to have to come in and turn that crank. And so their view of what the business is worth is going to be different from you as you are in that business. And hopefully there's a sufficient overlap of what they can do versus what you've been doing, so that in the middle you've got a negotiating range to work with. Are you selling, assuming that this is a corporation, because if it's a well-established business, the likelihood is that it is a corporation as opposed to a sole proprietorship. It might be a partnership that you're in, but assuming it's a corporation, then are you selling the shares of the corporation, or are you selling the business from within the corporation? So are you the seller, or is the corporation the seller of the business? And the leaning as the seller is generally towards selling the shares of the corporation, in large part because if it's a Canadian operation and it's truly a small business that you've operating, no involvement of foreigners or public corporation, then it will likely qualify for CCPC, Canadian Controlled Private Corporation status, and in turn, the shares on disposition over to someone, you will have the availability of claiming the lifetime capital gains exemption, which as of this year now, with the adjustments, is $1.25 million. So you can protect against the taxation of the capital gain on a very significant amount of the value of the shares. If you're selling the shares. If you're selling the assets, again, the corporation selling the assets, that's where a buyer tends to lean, because it gives them a lot more maneuverability from a tax perspective on their side of things as well. They probably don't want to buy the liabilities of your corporation. They'd rather have the business peeled out of it, because they don't want to have that extra liability of what the corporation might have done. They just want to get the assets out. So there's your two negotiating default starting points: buyer preferring shares, seller generally preferring to sell assets. Is it going to be a lump sum that's paid all at once, or is it going to be paid over the course of some period of time? One is at once, 2, 3, 4, 5 years, let's say, that it's going to be paid. And the amounts that might be paid over a longer period of time, it might be that there's a large amount up front, but then you have some kind of an earnout that applies. So again, depending on how well the business continues to churn out profits, the payments from the buyer, the new owner of the property, well, it is property, but the new owner of the business might be contingent on the productive capability of the business. So is there going to be an earnout, and how will you quantify that? What's the procedure you'll use for that purpose? Is financing needed? Are you needed as the seller to take back financing in order to make sure that the deal comes together? And if you're in that take back financing position, again, you now care a lot more about how well structured the business is that you are turning over, because you want success for the person who is going to take over from you, not just because you have always been a pillar in the community, let's say, and you want your name on the building, or the building's the business's name to continue on and support the community, but dollars wise, it's going to impact on you if you have take back financing, where you are effectively financing the buyer to buy from you. And then the tax part of things, lots of different elements can be involved in the tax part of things. So I'm not going to go into much detail of that. Again, the big one is if you're selling shares, you get the capital gains exemption. By the way, on top of that, capital gains itself, if you weren't monitoring it in great detail, capital gains for an individual are taxed at 1/2 income inclusion, up to $250,000 of capital gains in a single year. And then once you push past that with the new rules, 2/3 of capital gains are taxable. Whereas a corporation or a trust, but corporations, we're talking about business activities here, corporations, when they have capital gains, they are taxed on 2/3 of the capital gains from $1. So as a seller, you would rather sell shares. Even if you weren't going to get capital gains exemption, you can get 1/2 inclusion on the first 250, versus if the corporation that you own sells the business activity, 2/3 tax inclusion or income inclusion on that. So again, that much more reason why understanding, with the assistance of your accountant, mainly your accountant, but your accountant, your lawyer, what the tax treatment might be, is going to prepare you mentally and prepare you in terms of the availability of what money you're going to have later on, and how you want to structure things by having that tax conversation. The last thing that I'll touch on here is just about estate planning more generally. Estate planning for anyone, you need to have capable people who you choose to carry out the important functions. So that means that you want somebody who's going to be your executor, the person who executes your the instructions in your will, somebody who's going to be responsible. And likewise, if you're naming someone as your attorney, which operates, if you become incapacitated, in your place for you during your lifetime, you want capable people who are doing these things. That much more so when you're talking about the transfer of business. You might even have two wills, or carve out portions of the activity involved with the executorship, so that if there is a business that you own, and you're not necessarily on the verge of succession, but you want to make sure that you're well prepared for some kind of negative eventuality, like your own incapacity or your own death, then thinking through who might be appropriate to be executor responsible for the stewardship of the business in a way that then it can be sold, transferred on, and optimally realize upon the value should you come up short in terms of your continuing involvement. You died, by the way, is what I meant by that, in the business. Um, if you are looking to do something more elaborate, then having a trust in place might be part of the structure, particularly where you're looking at transferring on to family members, where you're going to bring them in, but maybe it's a staged progression of how they're going to become owners of the business, and you want to maintain control. There might be a good reason for having a trust in place so that ultimately they will receive the business, that most of the tax aspects of things can end up in the way that you want to tax structure things. But in the interim, until you get to that final moment, you would be able to maintain control over the business, bring in your family members who would be beneficiaries of a trust, and then eventually turn over ownership to them. Second to last point here about the secondary will strategy, as I mentioned, you could have a distinctive will specifically dealing with the shares of the business with a distinctive executor. It could be the same executor that deals with your estate generally, but again, it might be that you want to have someone who has knowledge of the business who you're going to put into that particular executorship role. The reason why second will is used is generally to avoid probate tax on the transfer of the business. If everything falls under one will, then potentially your ownership of the shares of a corporation that runs a business will then fall into your estate and be subject to probate tax. You can set up two wills where they don't, you have to draft them in such a way that they don't revoke one another. One of which will be to deal with the business assets, and it will not, the way that it's drafted, will not be necessary to submit towards probate. It also assists, apart from avoiding probate tax, don't be driven by probate tax as a primary concern. It's 1.5% of the assets that flow through the estate and flow through the particular will. If you've got a $10 million business at 1.5%, that's $150,000. That's probably a kind of situation where it is worth looking into this and having a conversation with your lawyer about how this will be of assistance to try to reduce down probate tax. If you have something less than that, then and I don't mean directly less than that, but something that which is going to require significant accounting and legal involvement in setting up the structure that pretty much offsets what you're going to save in terms of probate tax, then maybe it's a toss-up whether you bother doing it. The extra benefit, though, of having a secondary will is it provides another layer of privacy from the potential that someone will be able to find out what's going on with your estate if you have a will that does not get submitted to probate. And then the last thing here is that the tax liabilities. You grow up a business. It starts with some kind of a small investment, perhaps, and it grows in value, which then leads to a capital gain that eventually is going to happen. Whether you are able to protect against that during the course of your life through the structure of succession with family members, particularly, whether you can keep that from being taxed throughout your own life at the point of your death, then there will be a disposition of those assets which have a cost base, a market value at that time. Tax liabilities will associate with that if it's significant, and if there are not enough other assets in other places, it could mean the end of the business. If the assets in the business are going to have to be sold, some of them will need to be sold in order to realize cash, in order to pay the tax liability upon your death, then it could be the end of the business, or it could be a significant disruption. So that's where life insurance, again, can be a helpful tool to work with that. You pay the premiums cost for the insurance, and then if the unfortunate happens, then at the very least, the insurance can be used to pay off tax liabilities, preserve the business, and hopefully end up passing on to your family what value you had built up as intact as possible. I got this little phrase, the last thing I'm going to touch on here. I think it's the last thing, or maybe it was one more thing. I've got this phrase here. If you read through this, I am fully satisfied owning, managing, and working in this business with you. The thought here is looking at this phrase, who among you, yourself and the other people around you, your business partners, your spouse, your children, would they completely agree with this statement, or would they stroke out parts of it? And as an example of this, it may be that some of your children would be completely satisfied owning the business, but not managing. Some of them might be happy to work and just stand back and be managed by their siblings. That certainly does happen. So how do you look at this? How do the people around you look at what's going to happen with that business, your perspectives? And that'll give you a starting point to launch into as you're thinking about your succession of the business. This is the follow-up piece that we're going to share with you. Again, as I mentioned, it's a series of questions, 49 questions broken into the 7 categories. The one thing that's not, I know there were 8 categories I talked about, but the 8th was the professionals, which are just listed on the back. You can scribble them in. And otherwise, it's a whole bunch of questions that you can go through to try and sort yourself as you're looking at your succession. I'm done, Paul, but if there are any questions, we can chat.
So I'm smiling. I always get a bit of a laugh at the 49 questions, just, simple 49. But I've actually looked at the document, Doug. It's well laid out. It's very straightforward, and it's one tool that we can certainly use to help sort of some of those questions. So don't feel too overwhelmed by 49 questions. The homework's not that ridiculous. We only have a couple minutes left, so I'm just going to combine a couple questions that we had here. It was around the capital gains exemption. So apart from the capital gains exemption, and depending on the nature of your business, there might be different rules that apply, but is there any other ways to reduce tax when I sell the business? And there was also a question about using the capital gains exemption if I sell to my child. So maybe there's a difference between arm's length and sort of non-arm's length transactions, perhaps there.
Yeah, so the capital gains exemption, so one of the ways that you might be able to reduce down the taxes is if there are payments over time. So you can take a capital gains reserve up to 5 years. So if you're being paid out, if the buyer is paying over the course of up to 5 years, then the recognition of the gain can potentially happen over the course of 5 years. So if instead of having $1 million capital gain, just arbitrary figure, but $1 million capital gain in 1 year because it's an outright buyout, 250 of that would be a 1/2 income inclusion, and 750 would be subject to that 2/3 income inclusion. If you spread that over the course of a number of years, then you could reduce down the tax bill on those payments. Of course, you are then waiting for the money. You're not getting it as soon because you can't just arbitrarily say, I'm just going to spread it out because I feel like it. It has to align with the payments as they are coming to you. And you have to take at least 20% each year, and you can't take a higher percentage in later years. It pretty much aligns with the payments as they are made. So that's one of the ways that it can reduce down the taxes. Apart from that, there might be some situation-specific things about how you get paid out or reorganized before the sale. I'm not going to start speculating on what those things might be. As far as selling to family members, the latest intergenerational transfer of businesses rules that were passed. I can't remember how many years it was now. It's 3 years, 4 years ago. They were held up because it was a private member's bill that opened up the possibility of being manipulated. And so the government didn't have much say about it because it passed into law, including some members of the Liberal Party voted for it. And so it came into law. But to be implemented, the government did hold it up at the time. They have since introduced some adjustments to that, but the transfer of businesses, which was more challenging when you were transferring down to family members, has been somewhat alleviated. So if you're familiar with this at all, then You might have thought, oh, well, you can't transfer to your family members and be able to get the benefit of the capital gains exemption yourself and with those children. Now it's much more available to happen. It's very complex, though. I mean, I don't, I wouldn't even start to try to explain exactly what it is, but there has been some relief in the last year or so with the intergenerational transfer of businesses.
Okay. Well, no, thank you, Doug. I think it's safe to say that all business owners, regardless of the size, scope, or scale of the business, have a partner in the Canada Revenue Agency, and that tax implication at some point in the future is going to be a real issue to deal with. And I appreciate, there's numbers of different ways that we can do that with proper planning, use of insurance, proper estate documentation, and all those things. So I think all of these conversations, as you've touched on many times today, there's always going to be a personal aspect to it. You're going to need personal coaching. You're going to need really customized advice for your situation. And it starts with knowing what you want to happen for your business. So again, Doug, I want to thank you for your time today. I want to thank all of anyone who's watching this call live or as a recording for your time and your participation. We greatly appreciate it. We certainly welcome any questions you may have, and we look forward to an email and some follow up from us, and perhaps we'll have some great conversations on these topics in the future. Other than that, I hope everyone enjoys the rest of your day, and we'll talk soon. Thank you.
Thanks.